We start off with a big breakout in big energy. Crude oil surging 5%, closing above $50 a barrel for the first time since last February. The move driven by Saudi Arabia, shocking the market by unexpectedly cutting production. Energy stocks rallying along with the commodity. The XLE ETF posting its best day in more than a month. But the Chartmaster says beware of this big breakout. Crude realities are about to set in. We want to go straight to the Chartmaster, Cornerstone Macro's Carter Worth. Carter, Happy New Year.
Happy New Year, Melissa. Thank you. Well, just three charts. The first, take a look. I've drawn one line here, and what we would characterize this as is a rally to a difficult level, meaning with today's strength, just slightly over 50 before backing away, WTI undid all of its weakness associated with the pandemic, returned exactly to its late February level. Now look at the second chart. This is this exact same chart, just another way to draw the lines. You have a well-defined sequence here of lower levels. Basically, in September of 2018, we were at or near 70, and you can see that. Then in December of 19, we were at 60 plus or minus, and now we've rallied to 50, 70, 60, 50. It's a rally to a difficult level. Sometimes there is the buy the rumor, sell the news. Crude could have been up $10 a barrel, but it stopped not randomly right at that line, and I think that's important. The third and final chart, now this is a two-panel. It's the same thing we just looked at, the top being WTI, the front contract, which is February. And the bottom panel is relative performance to a broad basket of commodities, meaning the bottom panel is a basket with zinc and nickel and aluminum and corn and wheat and gold and silver and hogs and cattle, coffee and cotton. And what we know is that crude's move, impressive as it is simply a move in an ongoing downtrend. And so we're thinking you faded here. The big move, news-related, yes, is not likely to carry through. And just one other thing before we quit, it's not random that if you look at where crude closed today, 49.89 or thereabouts, Christmas crude, 12 months out, is at 48.55, lower than the front contract. We think there's a message there.
Carter, some might see this chart and see your call as a call on the broader markets. Is there a correlation there?
I don't think so. I mean, okay. I think this is very specific. We know there was news. We know it was, sort of a unilateral decision, 1 million barrels a day, I guess it is, from the Saudis. And so, and there was a big move. It moved 5%. But it's not random where it petered out if you draw the lines. All right. Carter, great to see you. Thank you. Likewise.
Carter Worth, the Chartmaster. Guy Adami, would you agree with Carter, and do you take it as a sign that maybe oil is telling us something if you believe it's going to break down?
Yeah, one of the first things I learned on this show is don't get too wonky inside baseball. But what Carter was speaking about is the backwardated oil market. And you could look at it one of two ways. I actually would look at it and say, if that back month, December crude or Christmas crude, as he talks about, is lower than this front month, I mean, some construe that as bullish. It's neither here nor there. I still think there's room to run. Kudos to Tim, by the way, that's been on this energy trade for a while. I understand what Carter's saying, and he's probably going to wind up being right. I think in the short term, though, there's still room to the upside. And we've talked about it now seemingly since October, when many of these names made huge double bottoms, not least of which ExxonMobil, but PSX, for example. We've talked about the levered energy plays. Just look at that name since October. 45, huge double bottom, 72 now. I think it could trade up to that 85 level we saw back, I think, on June 5th. And, that's one of the names that analysts haven't said anything about for a while. I think the last analyst upgrade or note was on November 5th in PSX. So although Carter's going to be right, I think over the next couple of weeks, there's still room to the upside in these names.
I hate to ask this question, though, but Dan, is this in some way a dash for trash, given where the markets are and the search for the next play here?
Yeah, so when you think about the XLE, we know that they're heavily weighted towards Exxon and Chevron. You look at Exxon, and Guy mentioned that double bottom that we saw in crude and related names, but Exxon's still 25 or 20 or so % from its June highs here. So there's still a lot of room to go. So if you're playing for beta, it could be there, especially when you see crude moving around the way it is. And I'll just throw in, put in that ISM manufacturing number this morning, which was much better than expected, near 2-year highs. You talk about inputs going into manufacturing. Obviously, crude oil is one of them. So you could make a near-term bullish case that manufacturing and a whole host of other industries opening up, despite the fact that there's still lots of COVID around and lots of mitigation attempts, that it's probably going to be something that's not just a 1 or 2 month trend, but you're likely to see into Q2.
Right. But of course, we also have to remember that along with the increased restrictions around the world, including here in the United States and Germany and Japan and London, the UK, I should say, that China, there's basically not a COVID problem anymore, Tim. I mean, that is the story of an economy that has pretty much recovered.
Yeah, and they had a slightly weaker manufacturing number earlier in the week, but yes, I think that's part of the story, and it's part of where OPEC is trying to balance short-term weakness to where they think medium-term there is a recovery, and that's why I think Saudi's unilateral move. Again, this came on a day when earlier in the day OPEC Plus, which includes Russia, found some unanimity and didn't cut, kept the same levels or didn't raise. There was some expectation you could have another 500,000 barrels out there, so this was a doubly good day, and go back to, Dan's talking about demand side. I think supply side is still a lot more important for oil. The fact that it appears that there's at least been some union, some meeting of the minds, and a more heavily consensus OPEC than we've seen in a long time. And back to the stocks. Look, oil services, if you look at $50 oil, that's great for U.S. shale producers. So, yeah, first of all, I think, the EOGs of the world, these guys talked about the integrated names, but certainly this is very good for the U.S. And in the short run, I think Russia probably hates this deal, but Saudi's taking the pain. But I think in the medium term, this is great for oil services. I've talked about being long Schlumberger. Last time oil closed above 55 on Brent, Schlumberger was a $34 stock. That kind of linear analysis doesn't always work, except for the fact that since that last time, Schlumberger is more cash flow positive, and I think has done a lot to actually kind of refocus their business to the oil market they have now, based upon fundamentals. So I like the energy trade. It's outperformed XLE to the S&P by about 10 weeks. Guy talked about these levels, and Dan did too, in the double bottom. So I think you stay there.
Karen, do you think you could find value in the oil market? And if we had a crystal ball and I said oil is going to stay, WTI is going to stay at around $50 a barrel for the rest of the year, does that change the equation for you?
Yeah, I would be skeptical that it would. But let's say you were to say that and it were to be true, then yeah, I think that there is probably a lot of places to look. And you talked about the dash for trash. I think if you had steady, it almost doesn't matter, above some band what price, but steady price for a long enough time, the levered ones, I think, would really do well. All that having been said, I'm skeptical of this holding together. And I think that it used to be there was the highest correlation between GDP growth and oil, and I think that's weakening somewhat. So I also feel like I've missed the trade. Kudos to Tim. He got it right. And so I'm not inclined to jump in here. I'm sort of in Carter's camp.
Guy, it struck me as amazing that Carter started off his hit saying that oil basically has erased all of the pandemic losses, that it's back to where it was pre-pandemic. In your view, should it be there?
Well, you have to then say, should it have ever been, back to the low 20s? And the answer is probably no. I mean, you could make a compelling argument that it should have fallen, obviously, March, April, May, but not nearly as precipitously as it did. And there were a lot of things going on. Remember, again, this is not a political show, but unfortunately we get dragged into it. There was a time last year or late last year, early this year, President Trump was calling for lower oil prices. The prices were too high, and then oil got obliterated. And then magically it was, he wanted oil prices to go higher because it was hurting some of our shale producers. So there was a lot of, I'll use the word, shenanigans going on in terms of the actual price of oil. So to answer your question, it should have never been as low as it was, and I think it's probably correctly priced here. I think to Tim's point quickly, oil stocks can do very well if the commodity were to flatline, even go slightly lower over the next couple weeks. And I think that's the environment that we find ourselves in.
Is oil now, is oil a barometer, and this is the sort of the question that I had asked Carter, Tim, is oil a barometer of economic health anymore? I guess I could ask, has it ever been in the past year or so?
Sorry for my mic issues before. I think oil as a measure of risk and where we're going, I think with broader macro, oil is a function of the dollar. Oil is a function of where rates are going. Oil is a function of reflation. And then oil is a function of the rest of the world recovering and a look to where we're going to be. So I don't think it's as much about how much risk you want to take on. I think it's more about we've rotated and we've actually moved into some of these names that were long-term underperformers. And I think that's the bigger part of this story.
Shepard Smith here. Thanks for watching CNBC on YouTube.